Hello and welcome back to the channel. I hope you're doing well. In today's video, I'm going to show you in Thinkorswim how you could actually set up trades to put probability on your side. So you can set it where you want 70% success, 80%, 90, 95% success. And you can actually understand that percentage before you even put the trade on. It's actually super simple to do, and it's a much better way of looking at trades instead of just shooting in the dark and buying lotto calls or lotto puts and hoping, the puts are printing and the calls are printing and da-da-da-da-da. That's not very consistent, and that's not probability. It's just not on your side. So this is a much more consistent, proper way to try trading, and it's pretty simple overall. It can be confusing, but I'm going to break it down for you right now. So Meta, I'm taking a look at Meta. It's gone on an absolute tear from the beginning of the year. And they just had earnings come out. And we've spent 2 days beyond what's called the Bollinger Band. The blue line is the Bollinger Band here. And the Bollinger Band simply is showing you 2 standard deviations beyond the mean of the stock. So when something gets beyond 2 standard deviations, the probability is that 95% of the time, actually, it wants to find its way back to the mean. So it wants to mean revert. And all that simply means is when the stock gets beyond the Bollinger Band, it wants to make its way back in. That's a very simple way to put it. So here we can see it got out of the Bollinger Band, it went back in. Here a little bit, here, so every single time it starts to get out of the Bollinger Band, it wants to find its way back in. So my strategy is very simple. When a stock gets very far out of the Bollinger Band, I want to sell calls above it. I sell the call because I believe that probability-wise, the stock will try to find its way back into the Bollinger Band. It doesn't mean it's just going to crash down $50 and get right back in here right away. It can still definitely keep going as well. It's not anywhere close to a guarantee. But over time, it will want to mean revert back into at least kind of a comfortable zone within this Bollinger Band. So when something gets super extended, it wants to come back in. I try to take advantage of that by selling the call options up here because I think the stock's going to go down. If it ended up that the stock was way down here out of the Bollinger Band, I would sell a put down here because I think that the stock's going to make its way back up possibly. So it's a very simple way to put it, but I want to sell calls. So what I do is I just went 1 week out for this because I do think Meta has potential to, I'm long in another account with it, and I do think Meta has potential to keep going up. But I'm taking advantage of just very quick 1 week out, a bit of calming down on this trade, and I don't think it will go over, 201. So I sell the option that's closest to the strike price. So I actually sold it for 365, and I buy the option that's at 205 strike price, so it's cheaper. It's called a vertical spread. I'm selling options vertical spread. The difference between the credit of 365 because I sold it and 248 is $1.20. So that means that I actually get credited $120. Now I did that for 3 of them, so I actually have the potential to make $351 if everything goes my way. And we see here in the Analyze tab of Thinkorswim, and this is where it gets very interesting with the probabilities. The blue line is showing my profit potential. As we get down here to the red line, this is when my profit starts to go away and I actually start to take a loss. So all you have to do is set a slice, and you want your calendar date to be 1 day beyond the strike expiry. So February 10th. So I set that to February 11th. And Thinkorswim is actually going to give me the probabilities of success. So if I draw the line right here where I start to lose money, it's a 75% chance that Meta is going to find itself below this price by expiry. 25% chance that it could continue up. So I've set myself up to have it so that I have a 75% chance of at least not losing money. If I go right here where I actually start to make max profit, I have a 71% chance of that working out. Now that's pretty good. I have a 75% chance of not losing any money by next week, and I can make $350. This is like a good, smart, kind of simple, consistent way to bring in money. Now, there's no guarantees. Meta could go on a rip. There's still a 25% chance that it happens. And there's ways to mitigate your risk. That's too much for this video, but there's ways to mitigate your risk if that does end up happening. But I just wanted to show you that this could be a lot more profitable for you on a consistent basis. And it's really cool that you can set up the percentages. If I move the price this way and say I wanted to say, oh, I don't think it's going to go over 206, there's an 84% chance that that's not going to happen. So I could actually set this trade up and sell the options and buy the options more towards the 205, 210 range. Now, I'm not going to be making as much money because it's lower risk. So I'm trying to keep it around, a part where I'm actually making a decent amount and I have a good probability on my side. I hope this made things a little bit more simple for you. If you're actually interested in this type of trading, check out my channel. I got more videos on this. It's just a very simple strategy. Put some probabilities on your side. If you have any questions, comment below. Maybe throw a like if you don't mind. I hope you're having a great day. Thanks for sticking around. I'll catch you on the next one.